One of the discouraging parts about getting started on your dividend journey can be the small and infrequent amounts of dividends received. While the amounts you receive is in direct relation to the types of companies you invest in and the yield they offer, the frequency or lack thereof is something that many dividend investors have tried to solve for. The most common solution for this frequency issue is often to sacrifice the quality of the investment for something that pays more often. I personally hate to see people making less than they could be and slowing down their own progress towards financial freedom because of these choices, so I decided to create this portfolio. If you stay to the end of the video, I'll be able to show you a high quality list of stocks, important information on each of them, and some great visuals and backtesting to drive home the point. Now, let's see the simple yet effective criteria I used to create this portfolio. It will feature 12 individual quarterly paying dividend stocks that all beat the S&P 500 with dividends reinvested over the past 10 years, have a 5-year dividend growth rate of at least 10%, have a current payout ratio under 60%, and consistently pay during the same 7-day period each month. In order to keep this portfolio diversified, I made sure there was no more than one stock per sector per month and no more than 3 stocks in any one sector throughout the whole portfolio. Also, I did not include any real estate stocks because of how those are taxed. I ideally think this portfolio is best held in a taxable account. I'm really excited for this one and I hope you guys are as well, so let's dive right into the list. So the payer for the first week of January, April, July, and October is Nike, stock ticker NKE, and they are in the consumer discretionary sector and have been paying and growing their dividend for the past 21 years. Nike has a forward dividend yield of 1.11%, a 5-year dividend growth rate of 11.15%, and a payout ratio of 34.42%. Nike is currently paying $1.36 per share per year, and their next ex-dividend date is estimated to be on March 4th with an estimated payout date of April 1st. Nike, over the past 10 years, has outperformed the S&P 500 by $17,112.22. Our payer for the second week of January, April, July, and October is Steel Dynamics, stock ticker STLD, and they are in the materials sector and have been paying and growing their dividend for the past 13 years. STLD has a forward dividend yield of 1.1%, a 5-year dividend growth rate of 22.36%, and a payout ratio of just 6.02%. Steel Dynamics is currently paying $1.36 per share per year, and their next ex-dividend date is estimated to be on March 30th with an estimated payout date of April 14th. Steel Dynamics over the past 10 years has outperformed the S&P 500 by an impressive $66,073.59. This next payer will be for the third week of January, April, July, and October, and that is Intuit, stock ticker INTU, and they are in the technology sector and have been paying and growing their dividend for the past 12 years. Intuit has a forward dividend yield of 0.74%, a 5-year dividend growth rate of 14.87%, and a payout ratio of 23.58%. Intuit is currently paying $3.12 per share per year, and their next ex-dividend date is estimated to be on April 8th, with an estimated payout date of April 18th. Intuit, over the past 10 years, has outperformed the S&P 500 by $42,472.18. The payer for the final week of January, April, July, and October is Agilent Technologies, stock ticker A, and they are in the healthcare sector, and they have been growing and paying their dividend over the past 11 years. Agilent has a forward dividend yield of 0.58%, a 5-year dividend growth rate of 14.34%, and a low payout ratio of 16.12%. Agilent is currently paying out 90 cents per share per year, and their next ex-dividend date is estimated to be on April 4th with an estimated payout date of April 27th. Agilent, over the past 10 years, has outperformed the S&P 500 by $19,832.04. So the payer for the first week of February, May, August, and November is Graco, stock ticker GGG, and they are in the industrial sector and have been paying and growing their dividend over the past 25 years. Graco has a forward dividend yield of 1.34%, a 5-year dividend growth rate of 11.85%, and a payout ratio of 32.77%. Graco is currently paying 94 cents per share per year, and their next ex-dividend date is estimated to be on April 17th with an estimated payout date of May 4th. Graco, over the past 10 years, has outperformed the S&P 500 by $8,479.57. Our payer for the second week of February, May, August, and November is MasterCard, stock ticker MA, and they are in the financial sector and have been paying and growing their dividend over the last 12 years. MasterCard has a forward dividend yield of 0.62%, a 5-year dividend growth rate of 17.37%, and a payout ratio of 19.15%. MasterCard is currently paying $2.28 per share per year, and their next ex-dividend date is estimated to be on March 4th with an estimated payout date of April 1st. MasterCard, over the past 10 years, has outperformed the S&P 500 by an impressive $43,147.75. The next pair will be for the third week of February, May, August, and November, and that is AbbVie, stock ticker ABBV. And they are in the healthcare sector and have been paying and growing their dividend for the past 11 years. AbbVie has a forward dividend yield of 4.09%, a 5-year dividend growth rate of 17.12%, and a payout ratio of 41.78%. AbbVie is currently paying $5.92 per share per year, and their next ex-dividend date is estimated to be on April 12th with an estimated payout date of May 15th. And AbbVie, over the past 10 years, has outperformed the S&P 500 by $30,054.14. The pair for the final week of February, May, August, and November is Williams-Sonoma, stock ticker WSM, and they are in the consumer discretionary sector, and they've been paying and growing their dividend for the past 17 years. Williams-Sonoma has a forward dividend yield of 2.42%, a 5-year dividend growth rate of 14.64%, and a low payout ratio of 18.47%. Williams-Sonoma is currently paying out $3.12 per share per year, and their next ex-dividend date is estimated to be on April 19th with an estimated payout date on May 24th. WSM, over the past 10 years, has outperformed the S&P 500 by $2,868.47. So the pair for the first week of March, June, September, and December is Kroger, stock ticker KR, and they are in the consumer staples sector and have been paying and growing their dividend over the past 17 years. Kroger has a forward dividend yield of 2.35%, a 5-year dividend growth rate of 13.92%, and a payout ratio of 22.71%. Kroger is currently paying $1.04 per share per year, and their next ex-dividend date is set for February 14th with a payout date of March 1st. Kroger, over the past 10 years, has outperformed the S&P 500 by $4,743.04. Our pair for the second week of March, June, September, and December is S&P Global, stock ticker SPGI, and they are in the technology sector and have been paying and growing their dividend for the past 50 years. SPGI has a forward dividend yield of 0.99%, a 5-year dividend growth rate of 15.15%, and a payout ratio of 24.75%. SPGI is currently paying out $3.60 per share per year, and their next ex-dividend date is set for February 23rd with a payout date of March 10th. SPGI, over the past 10 years, has outperformed the S&P 500 by an impressive $60,060.71. This next pair will be for the third week of March, June, September, and December, and that is Northrop Grumman, stock ticker NOC, and they are in the industrial sector and have been paying and growing their dividend for the past 19 years. NOC has a forward dividend yield of 1.52%, a 5-year dividend growth rate of 11.63%, and a payout ratio of 26.46%. NOC is currently paying $6.92 per share per year, and their next ex-dividend date is estimated to be on February 25th with an estimated payout date of March 16th. NOC, over the past 10 years, has outperformed the S&P 500 by $49,347.05. The pair for the final week of March, June, September, and December is BlackRock, stock ticker BLK, and they are in the financial sector and have been growing and paying their dividend for the past 14 years. BlackRock has a forward dividend yield of 2.79%, a 5-year dividend growth rate of 14.31%, and a payout ratio of 55.2%. BlackRock is currently paying out $20 per share per year, and their next ex-dividend date is set for March 6th with a payout date of March 23rd. BlackRock, over the past 10 years, has outperformed the S&P 500 by $6,098.13. Now, with all the stocks laid out, let's take a second to sum up this portfolio by the numbers. The average dividend streak of this portfolio is 18.5 years. The average 5-year dividend growth rate for this portfolio is 14.89%. The average dividend yield for this portfolio is 1.64%, and the average payout ratio for this portfolio is 26.79%. As I mentioned in the beginning of the video, I didn't want too much weighting in any one sector, so here you can see how this portfolio balances out. Now, if you're still on the fence about the potential of this portfolio, allow me to show you some visuals to do the rest of the talking. So let's get this one set up over here on portfoliovisualizer.com. I went ahead and entered our time period from 2013 to 2023. I included year to date for the most up-to-date information as of January 31st, 2023. And here I just want to make the initial and recurring deposits obtainable for the majority of people. I went with $1,200 initial investment back in 2013 with a continuous $1,200 for each of the following years, 2014 to 2023. Since inflation has been the word of the day for the past few years, it seems, I went ahead and made this one inflation adjusted just to keep up with the times. I went ahead and also made sure that we're balancing this portfolio yearly, and I don't use or encourage leverage, so I left that off. Of course, we're going to reinvest those dividends and we want to see the income. I personally have no idea what factor regression is, so I left that one alone. And lastly, our benchmark is going to be VOO that tracks the S&P 500. Now that we're all set up, let's see how this too good to be true portfolio comes out. So the intent of this portfolio, for simplicity's sake, is to put an even amount of money in each holding. So here you will see that we have all 12 of the holdings split up with 8.33% each, which gives us this really nice looking pie. As you heard in the earlier part of the video, there are some stocks out of the 12 that did better over the past 10 years than others, but I wanted to keep it as fair as possible since we wouldn't have known which ones would be the best of the bunch without the hindsight we have now. The first thing we'll look at here are the annual returns since the inception of this portfolio. You'll see the getting paid weekly portfolio here with the blue bars and the S&P 500 with the red bars. One thing to notice here is that when the S&P 500 did well, this portfolio did better, and when this portfolio was down, the S&P 500 was down more. One thing I did notice was if you look here at the end of the chart, the S&P 500 is outpacing this portfolio so far year to date. It seems like the S&P is getting mad at me for making this video and is doing its best to disprove me. Time will tell if that happens or not. Speaking of good years and bad years, let's take a look at this performance summary. Again, we had the initial balance of $1,200 for both portfolios, and in just 10 short years, you can see the getting paid weekly portfolio would have turned into $41,841, and that's versus the S&P 500 turning into $26,156 in the same time. Furthermore, the getting paid weekly portfolio would have had a 42.22% compound annual growth rate compared to the 35.75% from the S&P. Over here, the TWRR stands for the time-weighted returns, which you can see how both did here, but since we're adding money, that $1,200 every year and dividends are being reinvested, it's better to use the MWRR, which stands for the money-weighted returns, which again, the getting paid weekly portfolio won 20.23% to 11.59%. Next, let's look here at the best and worst years. Again, you can see that the best year for the getting paid weekly portfolio was 51.79%, versus the 32.39% from the S&P 500. And the worst year for the getting paid weekly portfolio was down 3.62%, but that's versus the S&P 500 that was down 18.19% in its worst year. And the last column that I'm smart enough to comprehend on this chart will be the max drawdown lines. From what I understand, the max drawdown is just the furthest each portfolio fell from its peak. You can see that this portfolio did fall by 18.51% from its peak at one point, but again, it's relative to the S&P 500 falling 23.91% from its peak. This screenshot really continues the story from the last one for anyone that needed further convincing. Without beating a dead horse, you can see that the only time, no matter what number you want to pull from, that the S&P would have been a better investment is if you would have sold out of this getting paid weekly portfolio at the end of 2022 and YOLO'd all your money into VOO on the first trading day of 2023, since the S&P is slightly outperforming year to date as of now. But since none of us have a crystal ball to know these trends ahead of time or a time machine to go back and get a free redo, let's just keep moving to the last two screenshots. Again, this one here is simple but effective representation to show the performance of both accounts side by side over the full 10 years. The top chart is the overall growth, while the bottom chart includes the inflation-adjusted numbers as we requested in the beginning. Again, the S&P is in red and the getting paid weekly portfolio is in blue, and you can see how this one ended. Now we can get to the part of the video we've all been dying to know. Troy, how much did this portfolio make in dividends? I'm glad you asked. Let's take a look. So all of these numbers are in yearly totals and dividends received. In the first year, in 2013, we would have made $28. In 2014, we would have made $53. 2015, we made $85. 2016, we made $123. In 2017, we made $165. In 2018, we made $228. In 2019, it was up to $314. 2020, we made $399. In 2021, we made $484. In 2022, we made $608. And so far, concluding January, we'd already be at $76 for 2023. Something I want to draw attention to is remember earlier in the video when I was talking about the annual returns and how up and down this portfolio was with the market? The first thing we'll look at here are the annual returns since the inception of this portfolio. You'll see the getting paid weekly portfolio here with the blue bars and the S&P 500 with the red bars. One thing to notice here is that when the S&P 500 did well, this portfolio did better. And when this portfolio was down, the S&P 500 was down more.
I told you.
Well, one of the best parts about dividends done right is within this chart. We saw no such thing with our dividends the whole time, up and to the right, just like we like it.
I like it a lot.
In the beginning of this episode, I set out to solve the issue of infrequent dividend payments. With this portfolio, over the course of 10 years, you would have turned your $12,000 into $41,841, beat the S&P 500 each and every year, received 480 dividend checks, and would be close to making $700 per year in dividend income. Keep in mind that all of these results are only with $1,200 invested per year or $100 per month. If you can do more than that, you can just multiply these results even more. The point of this is not to say how much we all missed the boat, but instead to show you with a portfolio like this, you can not only get paid frequently, but beat the market while doing so. I really hope you guys enjoyed this video as much as I did making it. If so, please be sure to leave a like to help others find this video, subscribe and ring the bell to stay up with all the dividend related content, and then use that comment section down below and let me know what you guys think of this concept and if this one could be right for you. And be sure to check out my latest upload right here if you missed it. But until next time,